Welcome to this Taxonomy Hot Topics update presentation. We are now in May of 2022 and we have learned so much about the EU Taxonomy from the proceedings in 2021, and we also know that there's a lot to come in 2022. So we thought we would give you an update of what has happened and what is to come. So for today, we have a fantastic agenda. Let's look at that. We thought we would first catch up on 2021 year and do some quick recaps of that. Then we will head into some remaining questions that we have struggled with on eligibility and the 3 KPIs that we need to calculate. Having passed section 1 and 2, we thought we would throw ourselves into alignment because that's really what's up now in 2022. So we'd speak about alignment difficulties. Then we're going to move into the future and speak about the remaining 4 environmental objectives that are to come. We will then speak about something that we call the extended taxonomy. We will listen more about what that is later on. And we will also throw ourselves into maybe what is to come, a social taxonomy. At least there's a report from the platform on that. We'll see whether it ever makes it into legislation. And then we will wrap up with what is coming around the corner and what we can expect next. So that's our full agenda for today. And I am Mikael Schea. I'm the PwC EU Taxonomy Working Group Chair. Joining me today will be members of my core team. I'll introduce them shortly. But also, we are very, very happy to have distinguished experts join us today. We have Nadia Humphreys from Bloomberg, and we have Linda Romanovska, PwC employee. They're both experts sitting on the platform, and we are so happy that we have had the pleasure on interviewing them for various aspects of the taxonomy. So you will be listening to them when we reach various parts of our presentation. But with me today, I have fantastic members of the PwC EU Taxonomy Working Group. So I have Nina Schäfer, Martin Schönberger from PwC Germany, and Anne Lenglet from PwC in France. And I represent PwC in Sweden. Anyway, let's throw ourselves into what we have called Chapter 1 and actually the year that has passed, 2021. Let's do some short recaps on that year. So if we switch a slide, we all know where we come from. We know that the objective of the taxonomy is to reorient capital flows into a more sustainable state. It's a classification system on sustainable activities. By now, we have all learned who has to use this. If you are under the NFRD, you fit certain size criteria, and you are a PI company, you have to adhere to the taxonomy. And in 2021, we started on eligibility, and this year we will move into alignment. If you are a financial company, you will still be in eligibility actually for 1 more year, then you will go into alignment. You know you have to put the taxonomy information in a specific non-financial statement. We have all been through the first publications in 2022 on the 2021 year. And for the first year, we only had 2 objectives out of 6 to work with, the climate change mitigation objective and the climate change adaptation objective. We have 4 more around the corner, but during 2022, we will still only have 2 environmental objectives to work with actually, to figure out whether we have sustainable activities or not. First year, we had to calculate 3 KPIs, and we will do so as a non-financial company this year as well. But the first year was a bit of a slow start because we only figured out whether we were eligible under the taxonomy regulation or not for our turnover, for our capital investments, and for our operational expenditures. And one has to remember that for financial companies, there were specific KPIs that they had adhered to, and they are still into eligibility for 1 more year. But the non-financial companies will now throw themselves into the full application of the taxonomy. When we started out in 2021 on this 5-step module that you can see in front of you, we only did steps 1 and 5 actually. We only figured out whether we were eligible for one of the 2 objectives, objective 1 or 2. If we found ourselves in one of the Delegated Act's appendixes, we thought that we said, okay, so I have an eligible activity. I need to figure out how much my turnover, my Capex and Opex actually are then eligible under the taxonomy. But we did not have to look into if we met any substantial contribution criteria, if we did no significant harm to the other objectives, and whether we complied with minimum social safeguards. That one piece of the legislation will come into play now in 2022. So let's look at what we have to work with. One more slide, please. When it comes to legislation, we have the regulation itself and we have the 2 delegated acts. So I'd make a point of saying that you always have to look into the delegated acts to find the actual activities, and then you need to look into the Delegated Act of Article 8 to figure out how to calculate your KPIs. So always bear in mind that you have to look into the legislation pieces as they are by themselves. You can't always just trust what people say. Please dig into these acts and figure out if you have activities and how to apply your KPIs. Further on, we have more materials that you can go to. We all struggled with the application of eligibility in the first year. So the Commission actually issued 2 batches of frequently asked questions, one in December 2021 and one in February 2022, when they tried to give additional guidance on how to apply the taxonomy. So please make a note of that there are FAQs out there that you should really carefully study, because in accordance with the Commission, these give you detail about how you should read the already issued legislation. In parallel to that, the platform on sustainable finance, the technical group that helps the Commission to actually work out the taxonomy and how it should work, have been busy. So they published a voluntary guidance. So if you want to issue more material than you are that you have to, you can use their voluntary guidance materials, so you know how to report when you do want to have additional information. They have also issued a table that helps you with correspondence of NACI codes with other classification systems, so that makes it easier for you to find out whether you have activities that are in the taxonomy or not. Also, the platform has been extremely busy. They have issued 3 other reports. Maybe of most interest right now is the final report on the 4 coming additional objectives. So that was published in March. So there is a huge report on the coming objectives, the technical screening criteria and activities. So please have a look into that. Bear in mind, though, that that's not final legislation yet. That's the proposal from the expert group. So we'll speak a bit more about when we can expect this to be turned into legislation. It's not so yet. They have also issued a report on the social taxonomy. We don't know when that will make it into a proposal for a legislation on the social taxonomy. We're still awaiting what will happen to that. They have also issued something called the extended taxonomy, which is of very much interest to corporates who feel that, well, I'm not really into the taxonomy, I'm not eligible, how can I report? Or I feel that I have some things that should be in the taxonomy, but I can't really squeeze them in. Is there any way for me to explain what my company is doing? So we will speak a bit more about all of these 3, the common objectives, the social taxonomy, and the extended taxonomy, and guide you through these materials. So if you don't think that that's a lot to cover already, there is more to come. Something we eagerly await is a report from the platform on minimum social safeguards. So we're eagerly awaiting some sort of guidance in order to help us on how to apply the minimum social safeguards bit. So hopefully that will come before the summer, so we can apply that and use that as our guidance for the minimum social safeguards. Also, complementing the final report on the 4 additional objectives, the platform will issue one more report where they will issue several new activities for the 4 remaining environmental objectives with technical screening criteria and do not significant harm criteria. So there's more from the platform to come. Also from the Commission, we believe that there will be more FAQs coming out, and this time they will be focused on alignment. We were hoping to see this before the summer, but probably they might not make it, and maybe in worst case they will be published late in the year, and we'll see how to adapt to them if they are published very late in the year. I spoke about the 4 remaining objectives and that the platform has issued a report. And I said also that these are not applicable yet because there's no legislation yet. And European Commission first has to turn this into legislation. Hopefully, that will be done before the end of the year. If that is done before the end of the year, our interpretation is that you then have to, during 2023, start applying those 4 new environmental objectives, and you will have to report on them in the spring of 2024 if you have a calendar year. However, if the Commission will be delayed, so we have no new legislation in 2022, might sort of be pushed into 2023, we believe, in our understanding of the taxonomy setup, that this will then mean that the whole thing will be pushed 1 more year forward. So you would actually have to report first on the 2024 year in the spring of 2025. So we don't really know if that timetable will be met, so that we will have to report on this on 2023. Otherwise, the thing will be pushed 1 more year into the future. So that's a thing to look out for. So, Anne, let's do 1 more slide. Final thing on reputation or recap. We should now speak about how corporates do their 3 KPIs. Just a short recap on that. You know that you have to calculate the denominator for the turnover that comes from your IFRS financial statements. You will go into the income statement and dig that figure out by using IFRSs. And then you have to relate that to your sustainable activities. In 2021, we only checked whether you had eligible activities. Now we have to take those activities and see whether you meet the sustainable activities criteria as well. And for climate change mitigation, that's easy. If you meet the technical screening criteria, you have turnover that is sustainable. However, if you have activities related to climate change adaptation, it can only be turnover recognized if the activity is an enabling activity. Otherwise, you can only count Capex and Opex related to that activity. So for turnover, you need to be careful when you're into adaptation so that you don't overcount. You have to check whether the activity is an enabling activity. Otherwise, you don't have sustainable turnover. So that was the turnover KPI. Let's have a quick recap about the Capex KPI. Same setup. We calculate the total Capex first. That would be using IFRSs to check for additions to tangible and intangible assets. So we're still using IFRSs to figure out the denominator, which makes that not easy, but at least a doable exercise for most people. However, then you need to figure out how much of that Capex that's not only eligible from eligible activities, but also that meets the sustainable criteria. So it's easy if you have Capex related to assets or processes associated with sustainable activities, you count those as sustainable Capex. Or if you have a plan to expand or make an activity become sustainable in the future, you count that Capex. What we've learned, though, is that even if you don't have activities that you perform that are in Appendix 1 or 2 in the Climate Delegated Act, you still have to check your Capex to see whether they are sustainable in themselves. So you would have to check from what supplier you purchased them, and if that supplier has activities were in the Delegated Act, that would be an eligible Capex, and then you would have to check the alignment criteria against what that party is doing to see whether you have sustainable Capex in its own sense. So Capex, the big lesson learned when the FAQs came out in February 2022 was that we need to check whenever we buy Capex from a supplier that is in the Delegated Act with their activity, that is something that we have to tally up and actually check whether that is sustainable in itself. So that was Capex. And when we go into Opex, we do pretty much the same thing as in Capex. However, what we've learned is the hard way that Opex is not something that is defined in IFRSs. So we need to go into the Delegated Act, find the definitions there of Opex, and then calculate the total Opex by fetching those figures from the IFRS statements. But we have to do a careful exercise of reading the Delegated Act and see what that actually says, because we can't get guidance from IFRSs. And then we apply pretty much the same workway as we did in Capex to figure out whether we have any sustainable Opex or not. So what we need to understand now, if we are a non-FS company, is that last year we calculated eligibility KPIs. Now we have to check for the same activities that made it into eligibility, whether they are aligned with the different criteria or not. And that means that we have a new KPI to calculate this year, a sustainable KPI for turnover, Capex, Opex. So that was the short recap of how the taxonomy works and all the reference materials and the 3 KPIs. However, as I've already said, there is more to come. We have then 4 new objectives that we are waiting for. Hopefully makes it into legislation at the end of the year. And we might have a social taxonomy coming around the corner as well. So a corporate might start thinking about whether there are some extra KPIs they already want to discuss, or whether they want to check for the 4 coming objectives to see, oh, okay, next year there might be something I need to actually calculate and report under. Maybe I should prepare already for that. But do be aware of that it's not legislation yet. It is not until the Commission publishes a new Delegated Act that we can start applying these and that they become mandatory. So with that, that was the short recap of 2021 and some words about what is to come. And I thought now we're gonna listen to what Nadia Humphreys has to say about what she thinks about the application of eligibility reporting from this first year.
So I work at Bloomberg in what's called our Sustainable Finance Solutions team, but I also have Bloomberg's seat on the Platform for Sustainable Finance, where I am the co-rapporteur for the data and usability workstream. And maybe if I can, I'll draw upon my Bloomberg role a little bit here, in the sense that we've been looking at corporate disclosure. At the moment, we've noticed about 2,250 companies have made reference to the taxonomy, particularly to the European taxonomy, in some form of disclosure, or even sometimes in earning statements. Now, of that very large number, just over 2,000, actually, we're seeing eligibility disclosure from about 150 of them, so a numerical value. We're seeing some go early with alignment disclosure, but again, very small numbers, about 20. And maybe a place that does need some investment is there's a very strict annex. It's called Annex 2, and it's in the Article 8 Delegated Act. We've only seen 12 examples of companies using that. And that, remember, was from a scope of 2,250. So I think in terms of usability, it's widely recognised that the companies need more support in understanding what the right thing to do is and how to disclose accurately. I think the main point that I would mention right now is the vocabulary used in reporting. You know, the ideal report right now would follow the Annex 2 in the Article 8 Delegated Act. But aside from that, what we are seeing is companies use, for example, pie charts to demonstrate the proportion of activities they're involved in that they consider to be eligible and or aligned. Now, in terms of taxonomy language, number 1 is the revenue that you are making from an activity that could be in the taxonomy is called eligible. What we do sometimes see is people use words like covered or in the taxonomy or applied to the taxonomy. The word you want is eligible. That's really going to tell you the percentage of turnover, capital expenditure or operating expenditure that is covered within the taxonomy is called eligible. And then the second thing that you may choose to voluntarily report ahead of time would be your aligned number. Now, an aligned number would represent that you can demonstrate substantial contribution to either mitigation or adaptation, that you do no harm to the other environmental objectives, and that you meet minimum safeguards. So in some instances, we are seeing companies call themselves aligned, but unable to justify do no harm, for example. Now, you're not supposed to use the word aligned until you are fully compliant with the technical screening criteria.
So on our side, we have performed an analysis on the 2021 annual publications, and specifically the part related to the taxonomy, of course, in order to identify some trends and practices in the way of calculating and presenting the taxonomy reporting. The idea was to answer to the following questions. How the groups have disclosed the information related to the taxonomy, to what extent they responded to the requirements of the regulation, and to what extent they possibly went further in the 2021 exercise. Maybe before going deeper into the figures, we can give you more details about the panel reviewed, which is based on 2 market index, the French CAC 40, and the European Eurostock 50. This base allowed us to see French publications, but also European ones. We have focused our analysis on the non-financial undertakings, and as a consequence, we have reviewed 57 annual reports. The two graphs on this slide show the split by industry and by country of our panel. So all the industries are represented, and in terms of countries, France is predominant, but we also cover 10 other European countries in this analysis. So now we wanted to give some information on how the EU taxonomy have been included in the annual reports. We have 95% or 54 groups of the panels that have included the taxonomy reporting. So all the following figures of this presentation are based on these 54 annual reports in which taxonomy information have been included. So first question, where the taxonomy information is disclosed? Mainly in the non-financial information part of the financial reports in France and in Europe. And we also have observed some mentions of the taxonomy in other sections of the annual reports, such as governance, for example, to precise how the audit committee has reviewed the taxonomy information, or the risk factors section. For example, the taxonomy have been included in a risk on compliance to the new EU ESG regulations. In terms of length, most of the groups, 85%, have taken less than 5 pages to present the taxonomy regulation, and even 30% have taken only 1 page. So it is only an order of magnitude, as all the annual reports have a different design and are presented differently, but it gives an idea. The groups that present more pages, between 5 to almost 20 pages, are groups that belong to the most concerned industry, such as energy and utilities or automobile, or groups disclosing alignment in anticipation. In terms of compliance with the mandatory disclosures for the 2021 reporting, we can see that about the KPI, 95% of our panel comply with the requirements by presenting either the 3 KPI required or only 2 KPI with the use of the exemption for the Opex indicator. In terms of eligibility, all the groups disclosing at least 1 indicator have presented the eligibility part, and 33%, or 17 groups, have given more details, such as the detail by taxonomy-eligible activity, or the detail by usual analytical segment of the group. In terms of qualitative information now, almost all groups have presented the methodology, and 76% have explained the level of the KPI, but even if these statistics are high, the level of details differs a lot between each group reviewed. We can also notice that 87% have given some useful information in order to reconcile the figures used in the computation of the indicators and the figures disclosed in the financial statements. In conclusion, global compliance with the requirement for this first reporting, even if we observe different level of detail in each reporting. In this slide, we wanted to present in what extent each industry is concerned by the EU taxonomy and by which objectives or activities. The first graph presents the level of the taxonomy-eligible turnover by industry, which is each time a minimum, a maximum, and the red point is the average. As expected, some industries are not covered. It is the case, for example, of aerospace industry, health industry, or the retail and consumer goods industry. On the other hand, and as expected also, some industries such as automobile or real estate are highly concerned. Finally, without surprise, also the objective 1 on climate change mitigation is predominant with around 80% of the panel that disclose it. If we could focus now on the Capex indicator, we have 94% of the panel that have presented this indicator. As for the previous slide, the first graph presents the level of the taxonomy-eligible Capex by industry. Maybe the thing to keep in mind here is that no industry have an average equivalent to 0. Meaning, even if the core business of a group is not covered by the taxonomy activities, it is almost always possible to disclose the level of taxonomy-eligible Capex. Indeed, we can see on the right side that the Capex belonging to the category C, meaning individually eligible, have been used by all industries and are a majority for the less covered industries by the two first climate objectives. Healthcare industry or retail, and consumer goods industry use this category C of Capex. In this individually eligible Capex, what were the taxonomy activities used by the groups? We have identified 3 main categories: the real estates for all the investments in new buildings or in initiatives to improve the energy efficiency of buildings, transport for the vehicle fleet, and information and communication for investments in data centers. Regarding the Opex indicator, 65% of the panel disclosed the indicator. In terms of level of the taxonomy-eligible Opex, we can observe that the same trends, in fact, than for the turnover ratio, meaning some industries without any eligible Opex and some industries with high ratio, such as automobile and real estate, as always. When the indicator is presented, we wanted to see which definition were used to determine the indicator, and we have observed 54% that comply with the strict definition of the taxonomy, 20% that used a more restrictive definition, including almost only the R&D costs, and 20% used an enlarged definition, in which either they used the day-to-day operating expense instead of the day-to-day servicing expense, or they only added the energy costs. Some other groups use other lines of Opex, but it is always different, in fact. When the indicator is not presented, we have noticed that more French groups did not present it than European groups, and that only 14 groups over the 19 that haven't presented the indicator, only 14 have explicitly mentioned the use of the exemption, and among these 14 years groups, only 70% have given an explanation or justification on how they have used this exemption. Sorry. In terms of threshold presented, we can see that it is either 5% or 10% that were used to justify the non-materiality of the taxonomy Opex. So now to finish with the figures, 2 slides on the additional disclosures. Firstly, 5 groups have disclosed an additional KPI, but without any trend by industry or type of indicator, as the 5 cases are different, in fact. And 10 groups have included a limited assurance report on the taxonomy information. 6 of the 10 groups are German, and over the 11 German groups of our panel, it represents 55% of the German groups. Now, in terms of information presented in anticipation of future reportings, 17 groups have presented such information. 4 of them belonging to the automobile or energy industries have calculated aligned KPIs in anticipation and have presented at least Capex and turnover, aligned Capex and turnover. 8 of the 17 groups have provided information related to the 4 following objectives with a different level of details, from a quantitative information for one group to only a short sentence mentioning that the group will be more concerned by the following objectives. So here are the statistics that we wanted to present to you.
Let's now move into Chapter 2, where we'll pick up on some residual questions on eligibility and some problems we have encountered when we try to work out the eligibility KPIs. First out, if we switch one more slide, we will again listen to what Nadia has to say about what she believes were the issues with eligibility.
What is an activity? So how do I therefore define eligibility in the context of the taxonomy? And a lot of the understanding on what is an economic activity is rooted in, do I make revenue from doing that activity? Actually, for the taxonomy, there's 3 lenses you look at it from. So one is the kind of revenue or turnover view. The other would be capital expenditure. And then the other would be operating expenditure. If maybe we focused to help on kind of what is eligible, when we go on revenue or turnover, really the incentive behind this was, am I doing something that is covered within the taxonomy? So it isn't a measure of green or environmental performance. Just means, am I doing something? And that thing I'm doing could be measured within the taxonomy. There's some complexity in that some of the activity descriptions are difficult to interpret. So an example here might be a car manufacturer. Now that's captured in an economic activity called manufacture of low carbon transport, but it's later clarified in an answer template that says really the low carbon definition only applies to the technical screening criteria. And so when you consider yourself eligible, it's the revenue you make from any vehicle manufacture, not just from what you may classify as low carbon. I.e., what we don't want is different vehicle manufacturers defining low carbon in different ways in terms of eligibility, and therefore the numbers become incomparable. So ultimately what you're looking for in an economic activity would be at the very headline of the description. So for example, manufacture of cement is any cement, and that cement could be very heavy carbon or could be a lighter carbon model, but eligibility is just telling you that that is what you are doing or making money from.
And let's now move into some of those eligibility hard, tough questions that we had regarding adaptation. So I'm gonna leave it over to Nina to work out how we best discuss eligibility and adaptation.
Yes, thanks. So I think it's really interesting what Nadia just explained. Taxonomy reporting requires a 5-step approach, and already the first step, the identification of eligible activities, is very challenging. So as Mika already said, another challenge is the assessment of eligibility for adaptation-related activities. Climate change adaptation is a very unique environmental objective because almost every economic activity is or will be affected by climate change in the future. And for this objective, 2 different types of activities are to be distinguished. First, the adapted activities, so here on the left side. Adapted activities are those activities that are made climate resilient. It is very important to note that no turnover from such activities can be recognized for the adaptation objectives, only Capex and Opex. And to report eligible Capex and Opex, the reporting entity has to perform a climate risk and vulnerability assessment. Only the Capex and Opex that are part of the plan to mitigate the identified risk can count as taxonomy eligible. So the European Commission's FAQ number 5 from February 2022 does not contain any criteria for this assessment, which means that companies have to make a judgment call on what makes sense for them and their business model. This judgment call will then define the percentage of eligible Capex and Opex. The second type of activities are the enabling activities, that is, activities providing adaptation solutions. As these activities provide solutions to others, turnover and corresponding Capex and Opex are eligible. However, there are also activities such as programming and broadcasting, education, arts and entertainment that are in fact both enabling and adapted. And for those activities, there are two different views on turnover. First view is to take 100% of the turnover because the activity could be enabling even if it actually does not provide any solutions at all. So this view is undoubtedly in line with the wording of the Commission's FAQ. However, view 2, that is to take only the percentage of turnover that qualifies as environmentally sustainable, is more plausible because it refers to the part that actually contains adaptation solutions. So view 2 might not fully be in line with the FAQ, and you will now hear Nadia from the platform of Sustainable Finance speak about this. So we asked Nadia, what does the concept of eligibility mean in the context of taxonomy reporting? So a company executes broadcasting activities, but does not provide information to increase resilience to climate risks. How much turnover should this company report as eligible?
In the Climate Delegated Act for adaptation, there are activities such as broadcasting or education. And I think at the very start, I explained to you that eligibility is going to create friction between what you could be doing that is aligned relative to the figure that is truly aligned. Now, I think we would all agree that in broadcasting or in education, even if 100% of your revenue is made through education, we really wouldn't want 100% of education to be climate adaptation related. It will only ever be a proportion. And I think it's a very good and valid question. It is one we have raised to get some clarity. The other thing you'll notice in the Adaptation Delegated Act is it talks a lot about implementation of measures, and those measures work well in the context of buildings, but to your point, don't necessarily work well in the context of a broadcasting activity. To understand what kind of broadcasting activity would qualify as helping companies adapt to climate change. So in those instances, that would definitely be places that I would expect to see more implementation guidance. Right now, my answer to you, though, would be broadcasting would be eligible. Education would be eligible, and that there is no expectation that you would refine that. I think that is likely to change over time, but at the moment, that would be my interpretation of the way it's written.
Now we're going to have a look at individually eligible Capex. In general, Capex is eligible if the Capex is associated with an eligible economic activity. However, there's also individually eligible Capex. And for this Capex, the Disclosures Delegated Act refers to two types of expenditure: the purchase of output from eligible or aligned activities, and the individual measures to reduce GHG emissions. There are still a number of questions surrounding this type of eligible Capex. For example, for certain outputs, it is unclear which activity in the Climate Delegated Act is actually the correct corresponding activity which is generating this output. And even after the FAQs by the European Commission, it is quite difficult to tell exactly if there are conceptual differences between the purchase of output and the individual measures on the other hand. As key takeaways, please note that the respective Capex is limited to expenditure that corresponds to activities listed in the Delegated Acts. This means it is not possible to define your own individual measures that lead to eligible Capex, even though you might undertake some measures that actually reduce emissions. And another point is that the individual eligible Capex includes a limit of 18 months for its implementation. So these 18 months, they will have to be respected in some way. We believe it is possible to treat the balance sheet date as the start of the 18 months period, which could give you a little bit more time to respect this limitation. Now, for the next question, we turn to a very special activity, activity 3.6, and how to understand eligibility. Activity 3.6 is a very controversial activity. This activity is a picture of other low-carbon technologies. Those are supposed to be technologies that are aimed at substantial GHG emission reductions in other sectors of the economy, as you can see on the next slide. One recurring question on activity 3.6 is whether it can be used for the supplier industry. For example, as you see here, for the manufacture of tires. There are basically two main lines of argumentation for this. We generally support the logic shown on the right, to say that only those tires are low carbon technologies that are themselves enabling GHG emission reductions, for example, by being particularly efficient tires. Hence, following this logic, the tire itself does the trick when it comes to GHG emission reductions. For example, due to the very efficient design, and it's not only the electric car to which the tires are attached that does the trick. But as you can see at the bottom of the slide, there's another way to reason for eligibility in terms with 3.6, which is based on the FAQs that were provided by the European Commission. FAQs focus on the objective of a technology for 3.6. And if you do that, so if you focus on the objective of a technology, you could argue that a very specifically designed tire that can only be used on an electric vehicle thereby has the objective to enable GHG emission reductions in the end by its design, even though the GHG emission reductions mainly triggered not by the tire itself, but by the electric vehicle. The part of the activity description referring to other sectors of the economy could also be tricky, but we do not interpret this notion too narrowly. For us, the main implication of this part is to say that such a technology may not only be used internally to reduce emissions in your own manufacturing process, but it needs to be enabling GHG emission reductions somewhere else. But we do not stress further in how far the customers of a specific undertaking are operating in a totally different sector. For example, car supplier, the manufacturer of car supplies, and the car manufacturer. But now on to the Opex KPI and its scope.
Thank you, Martin. Yes, we really wanted to insist on the Opex KPI because there were a lot of discussions last year about the definition, and which was not precise. So we already did special publication on the FAQs that were published by the Commission in February. Please refer to this publication for all details about these FAQs. But we really wanted to insist on one of them, which was the Opex, just to precise what said this FAQ. So the question was, what does it mean? Because Michael reminded the definition of the Opex. And in the Opex, this includes, in the last bullet point of the definition, Opex related to the day-to-day, and day-to-day what? Operating or servicing of the asset. And the FAQ said this is related to the day-to-day servicing of the asset. So you would take maintenance cost of employee repairing a machine, cost of employee cleaning a factory, or IT dedicated to maintenance, but you would not take overheads or raw material or things like that, or electricity, like as you have green electricity. So this is what the Commission had precised, and we wanted to highlight this FAQ. And another question that we wanted to share about eligibility is about R&D. The question is, how do we treat R&D activities? There are two options, in fact. So if we take an example of an undertaking which manufactures wind turbines, so with activity 3.1, how do the undertaking treat the R&D activities which are invest in the wind turbines? There is the first option, which is you take the R&D expenditure in the 3.1, or you treat the R&D expenditure in the 9.1, which is related to R&D, especially the activity. And so as for all questions in this webcast, this is not the final answer, as we will receive maybe some precisions from the Commission, but in our preferred view, we would see that first step is if you can allocate the R&D expenditure to an activity like 3.1, you do it. And the 9.1 is for activities R&D that are not related to other listed activities. But in all cases, you have to be consistent in the approach and be transparent about the treatment that you have taken for R&D or for other treatments that you conclude. To finish on the eligibility part, we wanted to raise a question to the platform, so Linda. So we have asked her, how can a company report or raise a request on an activity that is not yet eligible, but would have the potential to be considered eligible? So Linda.
So a little bit about me. My name is Linda Romanovska, and I am appointed to the EU platform on sustainable finance in my personal capacity as an independent expert, which means that on the platform, I am not representing any organization or point of view or industry. I provide my inputs purely based on my expert experience and based on evidence and science. At the same time, I am also an ESG and sustainability expert at PwC. I am based interestingly, in Sydney, Australia currently, where I am also a researcher at the University of New South Wales, where I'm looking at how do we integrate natural capital into sustainable finance frameworks. There are a range of opportunities for industries and companies to be engaged in the process of supporting the development of the taxonomy. First of all, you could be engaging with your sector association, for example. A lot of the sector associations are represented on the platform, and they are seeking feedback from their members. There are certain limitations in terms of confidentiality, but when they can, they certainly go out and look for feedback. We also do have a specific working group on data and usability, which is also regularly organizing roundtables and conversations with various sectors, also usually liaising with the associations to just have a broader reach, that also discuss the data and usability questions that then get feedback into platform work, and also as feedback to the Commission in terms of implementation monitoring. Then the other opportunities, of course, are the public consultations. Whenever there's a public consultation, either by the platform or by the Commission itself, any entity can submit a submission with an opinion, with also discussion papers, with any evidence that you would like to provide. The better argumented and the better, higher quality evidence, the higher the chance that this evidence can be taken into account in further taxonomy development. And the other possibility will be there in the future, because we, as a platform, also have the mandate and the task to set up a mechanism whereby entities, including companies, will be able to suggest further activities for the inclusion in the taxonomy. This is on our task list. This hasn't been a priority activity so far, as we wanted to first get out the criteria. And now there's also increased activity around this and thinking around that. How do we set up that feedback mechanism and mechanism through which we can receive these recommendations from the broader community? The information will follow. Currently, we don't have specific times or deadlines for this. However, that is something that you can anticipate and consider whether you would be interested to participate and put in a case for specific activities that you might be doing. Again, we will need very good evidence, because the taxonomy regulation does say that any decision or the design of the criteria and inclusion of the activities has to be science and evidence-based.
And now, Michael, the floor is yours.
Thank you. We will now move into Chapter 3 on alignment difficulties. And first out, we thought as an introduction to this subject, we would ask one of our experts another question. So this time we thought that we would ask Nadia an introductory question to this subject. And of course, we are all eagerly waiting for an answer to this question, and that is, when will these FAQs on alignment be published? And as we wait for them, what is her advice to companies that need to make a choice without having that further guidance? So let's listen to what Nadia has to say about that.
Yeah, it's a good question. So the Commission published a Q&A in 2 phases, one in December and one in February this year, around eligibility. And the Commission have made it clear that they wish to continue to provide further Q&A guidance with a focus on alignment. I think the thing, Michael, that we don't know yet is whether the Commission are going to formally ask the supervisory authorities for a level 3 implementation guidance. And I think that is one to watch at the moment in terms of next steps for usability. Within the platform, we are keen that more advice is given. We recognise usability as a struggle. We recognise there are continued open questions and definitely some edge cases in the way that companies report that they need more guidance on. So we would be very supportive of further implementation guidance. The year is ticking by us. I do have concerns that some of the guidance will be later in the 4th quarter of this year. And I recognise that would be a problem for corporates that are looking to report and comply with their alignment reporting. I very much recognise that is a problem. I recognise different actors who are doing the same activity may choose to report in different ways. I think there's still enough ambiguity that means that may happen. And as a result of that, I think your question was, what would be my advice? I think explain how you've reached the conclusions that you've reached. And I think if they are reasonable conclusions, they won't put you in kind of a negative place. And then there's always the opportunity year after year to improve and change and restate even.
Yeah, we have heard from Nadia that the much needed guidance on alignment will come later than expected, possibly not until the end of the year. And this makes it all the more important to interpret the existing legal loopholes and gaps in a meaningful and sustainable way, and to create transparency. And one of these gaps that a reporting company needs to fill is the question how to assess alignment on individual Capex. So individual Capex refers to category C in the numerator of the Capex KPI, that is Capex relating to the purchase of output from taxonomy-aligned economic activities and individual measures enabling the target activities to become low carbon and that are listed in the Climate Delegated Act. So for example, the reporting entity invests in a new car or in a photovoltaic panel. What is now required to verify that these assets are the purchase of output from a fully taxonomy-aligned economic activity? Taxonomy alignment means substantial contribution, do no significant harm, and minimum safeguards. From the outside, in most cases, the reporting entity can only verify the substantial contribution criteria. For example, whether the purchased car is a zero-emission vehicle. Therefore, it is, in our view, not permissible to either have no verification at all or to rely on internal justification, as simply guessing is no adequate way to fill this information gap. However, where to put the check mark on the other options listed on this slide is not easy to answer and strongly depends on the specific facts and circumstances. So in some cases, a simple confirmation email from the supplier might be sufficient. In other cases, more proof is needed. For example, additional information from the supplier's taxonomy reporting, or even detailed information on the alignment assessment of the supplier. A reporting company has to make a choice based on its relationships with its suppliers and on its own requirements for the quality, robustness, and reliability of the information reported. The taxonomy wants to put pressure on suppliers to adhere to the taxonomy criteria simply by using purchasing power. And reporting companies have to show that they are investing into something good. And with this being said, I hand over to Anne, who will explain to us how to apply the minimum social safeguards.
Thank you, Nina. Yes, let's talk now about the minimum social safeguards. So how to apply this minimum social safeguard in practice. This is a difficult question, and as we said before, we are really expecting the report from the platform this year. But in the meantime, we really need to apply this minimum social safeguards. So what we tried to do is, first of all, we propose an approach, but while waiting for more guidance. So what we will say in these two slides might change in regards of this report, which is expected in June or July 2022. Yes, so the 4 points to be highlighted. First point is the analysis to be done at group level or at activity level? And for this point, we will listen later to Nadia, but the pragmatic approach which is proposed is to say the analysis has to be done at group, at company level. There is not a special analysis to be made at activity level, but please take into account that this pragmatic approach at group and at company level should be a little bit granular in order to take into account risk-based approach, which is specific to activities or to localization, because there are specific risks related to special activities or specific risks related to localization. And this has to be taken into account in the global risk mapping at group level. So in an analysis at group level, the whole group is to be covered, even if not all activities are taxonomy eligible. And an example of that is that non-compliance could also result from a business segment that is non-eligible. That is something that we will need to follow. And the second point is, what is the minimum to be considered compliant? So while waiting for the report, what we propose is to inspire from the due diligence directive that is coming. So by analogy, so a company should have a formalized policy commitment on minimum social safeguards to meet the group responsibility. There should be also a due diligence process just to identify, prevent, seize, mitigate the actual and potential impacts. And third point, there should be processes to enable the remediation of the adverse human rights impact. Yes, and the company should also be able to assess the effectiveness of the measure, plus communicate on that. So this is applying by analogy the due diligence directive. And then a third point that we raise is what areas are to be assessed. So our preliminary views on that is that it should cover human rights, labor rights, and anti-corruption, like UNGP guidelines. And the fourth point, the question is, are there different levels of requirement depending on the localization, meaning in certain non-EU localization, should we have a less high level of expectation, or do we have to have the same approach for all localization? And on this point, our preliminary view is that no, this should be the same requirement. Some point of attention is that one failure does not automatically mean non-compliance if you have a processes of identification, remediation, and communication. And if anomalies are identified, there should be a justification that there is an effective process for identification and remediation in place. One question that we still have, and we understand this is a yes, but this should be confirmed, is that the whole value chain should be considered. And then, once again, this is really important to follow the publication of this expected report on minimum social safeguards, because this is what will help company to apply this in practice. And now we have asked Nadia Humphreys about when will the guidance be published on this minimum social safeguards, and what is her view on the minimum social safeguards.
There is definitely guidance coming from the platform on the application of minimum safeguards. And so that report should be available this summer. That is separate from the social taxonomy. So the social taxonomy report has already been produced. But what we recognise for things like minimum safeguards that perhaps I can share with you now would be they really are an entity level assessment of an organisation rather than an activity-based assessment. At the moment, you will already see that they draw on things like the UN guiding principles, the OECD multilateral guidelines, and the ILO conventions. So if a company is looking to demonstrate that they comply, it would be looking at key policies and processes. I think generally speaking, what we are keen to encourage is that companies do the right thing. So large listed companies may well be exposed to social issues somewhere in their supply chain. And we definitely want a model that encourages companies to look to audit from a social perspective their supply chain, to uncover those issues, and then to engage and remedy. So when we think about this in a data model, we're very nervous about the idea that a controversies-based model would be something that prevails, particularly a controversy that might be based on, you know, an emerging news story, for example. What we do want to do is encourage large listed companies to really look at where they have problems and talk about those problems and talk about their plans to fix them. And I think that would be a better way forward in terms of understanding minimum safeguards. A lot of people want a simplified data model in terms of the yes/no answer. And I think it really does depend on the nature of the issue, whether there was a failing in the safeguard that resulted in the social issue, or whether actually by identifying the issue and implementing plans to immediately fix it, or implementing an engagement plan, particularly with supply chain over the next 2-3 years, whatever it may be, that is practical and realistic, might be an appropriate response to that situation. And I think what we are trying to do in the platform to provide advice is give a little bit more specific advice and guidance on how you can make that determination as to what is a situation that would mean an investor would divest from you because you are deemed not to be meeting your minimum safeguards.
Next up are the templates provided in the Disclosures Delegated Act. Many of you will already have taken a look at the extensive disclosure templates that need to be used for the next reporting period. We also have an excerpt of the template for the turnover KPI on this slide. One early question that came up with the template is how it is to be used in case an activity substantially contributes to more than one objective. Like in the future, an activity could, in theory, contribute to up to 6 climate objectives. As a general rule, double counting needs to be avoided. So even if an activity might contribute substantially to multiple objectives, overall, these contributions may not just be added up for each objective. So undertakings will need to choose a certain allocation. In our example here, the undertaking is confident that 90% of their turnover associated with activity 1 is substantially contributing to climate change mitigation. However, 10% of the turnover, for example, generated by a very specific product within activity 1, contribute to both climate change adaptation and the protection of water. For our example, undertaking the contribution to water protection is more pertinent. Hence, these 10% are allocated to water protection, and climate change adaptation ends up with 0% in the template. This fact, of course, also needs to be explained in the qualitative disclosures about the contribution of the activity. But there's no clear rule on how this allocation is to be made. For example, the undertaking could also split the 10% into 5 and 5% for adaptation and water, if this allocation is deemed to be more reasonable or they have their specific reasons for it. Now we're heading over to climate change adaptation, and we start with the question when a climate risk and vulnerability assessment has to be performed. Nina, please.
Yeah, thanks, Martin. So a climate risk and vulnerability assessment is at the heart of the climate change adaptation objective, because climate change adaptation is about solutions to reduce the risk of the adverse impact of the current or future climate. To identify adequate solutions, a robust assessment of the exposure of the company's activities to climate change is necessary. And such an assessment is to be done in two cases. First, for activities in Annex 1 to the Climate Delegated Act, because these activities have to demonstrate that they do not significantly harm the other environmental objectives, including climate change adaptation. And second, for adapted activities in Annex 2 to the Climate Delegated Act, because these activities have to demonstrate substantial contribution to climate change adaptation. And I'm delighted that Linda from the Platform on Sustainable Finance is now going to tell us about how to apply such a robust climate risk and vulnerability assessment. On the next slide, please.
So in terms of scope, it is the scope of your operations pretty much. So when we talk, we don't talk about specific one location. We don't talk about specific one type of operations or one type of activity when we talk about climate change risks. We talk about anything anywhere within your value chain that can happen as a result of climate change, either now or in the future, and aligned with the timeline of your activity, and cause some serious trouble to your business. Either it can cause serious delays, disruptions, or it can cause material significant financial losses, anything that has an impact on your bottom line and your functioning as a company, as an entity. It doesn't always mean that that impact will be where your headquarters are. It doesn't always mean that the impact will be where your manufacturing site is. It also can be an impact on your suppliers. It can also be an impact on your transportation, on your logistics. It can be impact, in fact, anywhere in the world where you have any sort of footprint or connection to. And so if you know that you're highly reliant on a certain supplier in a highly vulnerable area and they are facing significant climate risks, then probably that is something that will be a material risk for you and your operations. And so we are not limited to one narrow area here. The framing and the mindset here is what affects me as a business. And it is not that dissimilar to any other risk management in a business. So you should treat climate change risk very similarly to all other material risks in business. And what we're seeing increasingly is exactly that companies are integrating climate risks and assessment and management in their overall business risk management. And the whole principle about materiality, you can apply the same way to climate change risk as you apply to other business risks. And if you already have a concept of materiality or determining materiality for other risks, then you can also apply the same principles. In short, the criteria in the taxonomy do not prescribe specific thresholds for materiality. So you do have your own discretion, you have your flexibility to define what is material for you. It does have to make sense.
Yeah, this is very insightful guidance from Linda. When we look at climate change and the related physical risk, a geographic approach will be adequate to perform the risk and vulnerability assessment in most cases. The specific location determines the physical hazard, the exposure and sensitivity to physical risks, and also the adaptive capacity. So how defenseless is a location exposed to climatic changes? Let me give you some examples. A train manufacturer will start its analysis at production site level. However, as we've heard from Linda, the whole value chain has to be taken into account. If a material risk occurs within the supply chain of that manufacturer, for example, a crucial component for the train, this risk needs to be evaluated. Second example, for transport by train, an assessment of the rail network is necessary. So next slide, please. Yeah, one of the most important messages from Linda is that the scope of the assessment does not only cover the company's own locations, but the whole value chain. So a car manufacturer might have a limited number of production sites. Additionally, risks affecting important suppliers and distribution channels, so the upstream and downstream value chain, need to be taken into account. Whether a step-by-step application of the value chain assessment is possible, that is demonstrating incremental progress over time, this needs to be discussed in the coming months. Yeah, Martin, what else can we say about the risk and vulnerability assessment?
Yeah, thank you, Nina. This is basically a summary on, in parts, still open issues with regard to performing a risk and vulnerability assessment in practice. So as you heard, it is not clear at which level the assessment has to be done in detail. Generally, climate change adaptation is about the risk for an entity's business, that is, all the operations as a whole. But of course, the exposure to climate change will be different depending on the relevant geographic locations. On a similar note, again, as you also heard from Linda and Nina, the value chain should be considered. So what can we say? Doing your best to include the value chain into your assessment, particularly in the first year. This way of thinking, of course, it will be a certain process that all undertakings have to go through. Shortcuts in the sense of estimations, extrapolation, and allocation keys should be viable. Like, for example, for the physical climate risks on transport activities, you will most probably form certain clusters of roads and not analyze every road or connection individually. Such approaches then need to be explained in the qualitative disclosures on how you went about your risk assessment. In general, it's not enough to just have a strategy for adaptation to climate change. You also need to show that appropriate measures have actually been put in place if necessary, so that you actually took action to mitigate material physical climate risks. A very important message is to not underestimate the potential impact of climate change. The impact of climate change can be very diverse. It's not just about certain very obvious risks, like the risk of flooding if you have material production sites near the coast or near large rivers. Climate change can, for example, cause health risks for your employees in certain regions, which can lead to reduced working hour limits in case of extreme heat or extreme weather in general. The flow of a certain river might close transportation routes that cause delays and disruptions in your value chain. And there are many, many more examples. So you should not be too quick in dismissing the impact of climate change as immaterial. The measures to mitigate climate change related risks can also be very diverse. It can actually be monetary reserves that are specifically set aside to cope with certain impacts, but also soft measures such as trainings or different policies you put in place. In the end, the key is that such solutions are actually effective in mitigating physical climate risks. Now we will transition to the application of other technical screening criteria, and we start with the question how the European criteria are to be applied outside of Europe. So, you go on, please.
Yeah, thank you, Martin. Yes, we continue our hot topics on alignment, and one which is regularly raised is regarding EU and non-EU criteria. And we will see that it's really depends on how the criteria are written. So we have taken an example with real estate and with the activity 7.1, which is the construction of new buildings. In this, in the description of the activity and in the criteria, it is referred to at least 10% lower than the threshold set for the nearly zero energy building requirement, NZEB, in national measures implementing Directive 2010-31 EU of the European Parliament. So in this criteria, the question which is raised is how do we apply this threshold in practice outside of Europe, where this NZEB directive does not exist. So if we take an example of a building of a subsidiary in China, what do we do? Do we apply a threshold, a Chinese threshold according to local law, or do we apply other thresholds which are related to EU threshold? What is really important in this slide is to understand that we are dealing especially with this activity because it will always depend on how the criteria are written. And in this case, it is not possible to consider that we could apply a local, so a China threshold, because the criteria are referring to non-EU threshold. So we have considered other way of applying in practice this criteria because this was not easy. So there were many solutions. For example, to take the lowest requirements in Europe, would it be acceptable? Or an average of the different threshold of certain European countries only, or the average of different threshold of all European countries, or also to adapt the threshold based on one European countries which could have comparable characteristics, like, for example, same climate characteristics. So there could be diversity in practice, and there is a risk of non-comparability because companies will use different thresholds, but what we find acceptable would be the last 3 examples on the slide. Yes, that's it. And another example on this criteria is also for DNSH, which are quite common. And on this slide, you have 2 activities listed with DNSH, which are referring, the first one on the sustainable use and protection of water, which is referring to activities in third countries where it could be applicable to use national law. And the second one, this is the same because for activities in third countries in accordance with equivalent applicable national laws, etc. So the point really is to verify the DNSH criteria in jurisdiction outside of EU and to be transparent about what criteria has been selected. And also it can depend on the activities. And we will follow also how the European Commission address this issue in the coming FAQs. We have another question on alignment, which deals with mitigation and which refers to the notion of best technology. So in this slide, we just listed for your information the 23 activities which are concerned by those reference to best technologies. So you have sometimes best available technologies criteria, best available techniques reference document, or best performing alternative. So this is just a list. And now let's talk about the application in practice. So we took an example with the 3.6, which is manufacture of other low carbon technologies. And the criteria here, it refers to substantial contribution with a substantial GHG emission savings compared to the best performing alternative technologies. So on this point, the question is how to understand this compared to the best performing alternative technologies. So first point, do we need to be better than the best? Or should we understand it has to be among the top performers, so in the top 20%, or does it need to be above average? So this requires judgment, and in our view, the first 2 boxes could be acceptable, but once again, the company should be transparent in their choice and judgment. And then there will be a difficulty of comparability. And for us in the same sector, if the company didn't choose the same rule, we'll have a problem of comparability. So then you can also have problems about the population of comparables that you use, because this is one thing to say this means better than the best of among the top performers, but you also have to define of what, 20% of what. So the population is quite important also, and this is a little bit a sector discussion to have. Now let's talk about the next question.
Yes, thanks, Anne. This is a quick one, so we can jump right into the next slide. It's about certain activities that include really complex technical criteria, and that they require an external verification, and particularly of the achieved GHG emission savings. And you can see the full list of such activities here. And this external verification needs to be performed by an independent third party. That is what the Climate Delegated Act says. So far, there's no further guidance regarding this external verification. So it is not clear how such a verification could look like, who can perform such a verification, what kind of assurance or opinion or form of attestation is needed in the end, and which independence requirements need to be applied to actually verify an independent third party. Due to this lack of specific rules and guidance, we believe that the compliance with this requirement is subject to significant judgment by the reporting entity. So it is your judgment call. The undertaking then should therefore describe how they cope with the external verification and which rules they set for themselves to ensure an independent verification. Next up are the Capex plans and the question, what is necessary to justify a Capex plan? This question now focuses on the so-called category B Capex, as Capex is reported as aligned Capex if the Capex is part of an expansion or upgrade plan. The question is when an investment plan is considered such a taxonomy-related plan. And one solution to this question could be that a declaration of intent concerning the target to be taxonomy aligned in the end, that is agreed also by the management, is enough to have such a plan already. That means like saying, okay, we have an investment plan, for example, on setting up a new site. And at this site, in the end, we're of course planning to perform a fully aligned activity in the future. With that approach, such Capex or all then related Capex would be taxonomy aligned if the required disclosures about the plan are made. We believe that this is not enough. We believe that only having such a target is not sufficient to be considered a plan in the sense of the taxonomy. Instead, in order to actually be a taxonomy upgrade or expansion plan, the plan needs to include certain concrete measures how the alignment criteria are realized. So the plan shall include taxonomy-specific considerations for the investment. Important to note at this point is that this does not mean that such technical details of the plan also need to be disclosed to the public. The disclosures are basically what they are following the Disclosures Act on Article 8, which are aimed at disclosures at an aggregated level. As a final note to this regard, even though these disclosures are rather focusing on aggregated information than technical details, these disclosures might still include a number of sensitive information. But similar to the IFRS, there's no exemption to avoid such disclosures for alignment purposes for taxonomy reporting. Now, we also have another take by Nadia, who explains the relevance of alignment plans. So enjoy.
The important metrics, actually right now, the really important metric, I think, is capital expenditure. If you are spending money in such a way that your business can perform in line with the taxonomy, and that's with a maturity of 5 years, potentially 10 years where warranted, that is a really important investor metric right now, because I have an indication that I should continue to hold you as a stock in my portfolio, because in 5 years' time, you will be performing in a way that is taxonomy aligned. Because right now the numbers are low and companies are not performing in line with the taxonomy. And that's widely accepted, but I think that is an uncomfortable truth that people are living with right now.
Let's then move into the future a bit. As I said in the introduction, we are going to speak about the coming 4 other environmental objectives. But I think we are all a bit curious about when this will make it into legislation as such. So we thought we'd interview and ask that question to one of our experts. So let's introduce our expert on the next slide. So we said, Nadia, what do you think about the Delegated Act for the coming 4 environmental objectives? When do you think that will be final? And depending on when that becomes final, when do companies have to report on those objectives?
It's the unknown answer, to be honest with you. So definitely the Commission right now are writing a Delegated Act with recommendations from the platform on the 4 environmental objectives. I definitely think there's an ambition that Delegated Act is finalised by the end of this year, but that is a very heavy ask to get it through trilogue and approved and published in the journal by the end of this year. So in terms of kind of the original timeline, it was that eligibility would be reported in 2023 with alignment 12 months later. We don't know whether that timeline is necessarily going to be kept, because there is also a commitment that when the Delegated Act is published, there would be a 12-month window for implementation to take place. So I think some of that timeline is still up in the air.
So we've heard from Nadia that it is very difficult to predict when the new Delegated Act will be final. And therefore, it is equally difficult to predict when companies have to report according to the new objectives and the new activities. So on the next slide, you can see that for the next 4 environmental objectives, Article 8, paragraph 5 of the Disclosure Delegated Act states that the taxonomy KPIs do not cover these objectives until 12 months after the application of the new Delegated Act. So in case the new Environmental Delegated Act applies starting from 2023, reporting starts 12 months later, that is in 2024 on 2023. And the same timeline could also apply to the additional activities that contribute to the first 2 climate targets and that are included in the platform's report. This is because the taxonomy regulation basically provides that preparers shall have 12 months to prepare for the application of new technical screening criteria. However, everything depends on the finalization of the new Delegated Act. Yeah, and now we will take a deep dive into the 4 other environmental objectives. And we will start with Linda from the Platform on Sustainable Finance and the question, what are the main points of attention of the coming Delegated Act on the 4 other environmental objectives?
By now, I believe a lot of audiences will have already had time to read through our report and have some idea of what we are putting forward. Just a reminder, so this is a report that's being issued by the EU Platform Sustainable Finance. We are an advisory body to the European Commission. It is not yet the final or not even the draft text of the regulation itself or a Delegated Act itself. It is then up to the European Commission to take our recommendations and start putting them through the public consultation and political process. And there can be still changes expected in that process. And so what I'm talking about are our recommendations, but not necessarily the final product. What we have been focusing on in the last 18 months, working on this report and our recommendations, are the additional 4 environmental objectives that were not covered in the first Delegated Act. As you know, the first Delegated Act focused on mitigation and adaptation of climate change, and the current recommendations are focusing on the management of water and marine resources, on transition to circular economy, pollution, and also biodiversity topics. So as you can imagine, that's quite a broad scope. I would say that quite a lot of the focus has been on biodiversity and circular economy. However, we have been covering all of these objectives. In terms of what kind of sectors we have been covering, I believe it's around 20 different sectors and a rather high number of activities. Of course, during the course of our work, some of these activities have now fully developed proposed criteria. Some of them have been postponed for further work, and some of them have also been either merged or split up in separate activities. So there have been some changes in comparison to, let's say, earlier versions that went out to public consultation. The types of sectors we're talking about are really broad ranging. We're talking about agriculture, forestry, fishing, various manufacturing activities, energy. We're also looking at other objectives than mitigation and adaptation in terms of energy. We're also looking at civil engineering, building, construction, certain activities around transport. Transport was already present in the first Delegated Act, but it is again, we're adding further activities for further objectives there. Disaster risk management, restoration and remediation activities, also tourism, water supply and sewerage, waste management, and some services. So as you can imagine, that long list of sectors and a long list of activities results in a high number of recommendations that we have drafted right now. And so I cannot explain in detail everything that is in the report. You will need to go in and look at the report yourselves. But this gives you the idea of the very broad scope, both in terms of sectors that we are currently working on and also the scope of the various objectives. What I would like to also mention is that we do not purely focus only on these new objectives. We are also still adding new activities for the first two objectives, which is mitigation and adaptation. Specifically on adaptation, we have around a dozen new activities added. And so there is a considerable addition that we are proposing to the first Delegated Act here as well. And so when we talk about the second Delegated Act being on environmental objectives, it is not entirely correct. It actually does cover the whole range of 6 objectives currently.
The next question to Linda is born from the experience that the first reporting, according to Article 8, the taxonomy regulation, has shown that companies have problems in determining their taxonomy eligible activities. So we asked Linda what her advice is regarding the new Delegated Act.
In fact, that is one of the current biggest shortcomings of the taxonomy, its limited scope, because we know that what is not in the taxonomy is not necessarily not sustainable. It simply has not been included in the taxonomy. And there are many activities still out there that are and could be legitimately sustainable and make substantial contribution. They simply have not been included yet. And that is very often due to the limited resources that we have as a limited, a size of limited expert group of a limited size working on this in a technical manner. And so that is the opportunity. The difficulty perhaps is to make sense of it, to understand, first of all, is my activity in there? So understand the scope of the activities themselves. And as before, the recommendation there is to stick closely to the wording of the activity description. Again, word of caution, there still might be changes. However, you can already get an indication of how the scope of the activity looks like. I would say that in this work, we have been much more precise in trying to define the activities and explaining the scope of them, because we have seen some of the issues in implementation around some of the activities in the first Delegated Act that had a bit more generic or brief descriptions that perhaps did not clearly delineate. We have also tried, in many cases, to indicate where there can be questions around overlaps between activities, because some of them start to become coming close to each other, and so we need to find that delimiting space. For example, how far up value chain we look for food production and what is in the scope of agriculture, right? So where is that line? And so we have tried to put in those delimitations and sort of make decisions and make it clearer where do you fall in.
So Linda has given us some very important insights on the sectors covered by the platform's recommendations and on the platform's work to define the scope of the new activities more precisely. So let me tell you a little bit about the platform's recommendations. Well, first of all, these recommendations do not present a draft legislation. They are addressed to the European Commission, which will publish a draft delegated act based on these recommendations. This is expected to take place this summer. The platform's recommendations on the 4 other environmental objectives are contained in 2 reports. One is Part A, methodological report, and the other Part B, with the technical screening criteria for 11 sectors in total, covering 55 activities. Part A contains important explanations on the methodology for the technical screening criteria, in particular on the development of headline ambition levels and the substantial contribution to a given objective. So when a company already starts screening report B for its activities, this should be more than a tick mark exercise, because the company should thoroughly examine Part A to understand the reasoning behind the technical screening criteria. So next slide, please. So here we see what are the headline ambition levels for the 4 other environmental objectives. First, sustainable use and protection of water and marine resources. The ambition here is to ensure at least good status for all water bodies by 2027 and good environmental status for marine waters as soon as possible, and to prevent the deterioration of bodies of water that already have a good status. Second, transition to a circular economy. The aim is that by 2030, economic growth is decoupled from extraction of non-renewable resources, and by 2050, economic activity is largely decoupled from resource extraction. This shall be done through environmental design for a circular economy to eliminate waste and pollution and keep materials and products in use at their highest value. Third, pollution prevention and control. The ambition here is that by 2030, pollution sources, sinks, and pathways due to human activities have been fully identified, and measures have been applied that prevent and eliminate pollution across air, water, soil, living organisms, and food resources. And fourth, protection and restoration of biodiversity and ecosystem. The aim is to ensure that by 2050, all of the world's ecosystems are restored to a good ecological condition, resilient, and adequately protected. So from today, the world's biodiversity needs to be put on the path to recovery. Next slide, please. Yeah, so based on these headline ambition levels, it is important to understand how the 4 environmental objectives interact. This interaction is based on the so-called DPSIR framework: driver, pressure, state, impact, and response. According to this framework, social and economic developments, that is the defined drivers or driving forces, exert pressure on the environment. As a consequence, the state of the environment changes, such as the provision of adequate conditions for health, resources available, and biodiversity. And finally, this leads to impacts on human health and ecosystems. And that may elicit a societal response that feeds back into the driving forces. Yeah, to understand the substantial contribution criteria, one must understand the interactions between the environmental objectives. So these interactions are related to where the objectives appear in this DPSIR framework. For example, pollution, in the figure bottom right, is a pressure that affects the state of the biodiversity and water objectives. Circular economy, in the figure on top, can be seen as a response that helps to achieve the desired state of an objective or to reduce the pressure on an objective. And the headline ambition levels, they reflect these positions. So the water ambition level focuses on improving the state of water bodies. The same applies for the biodiversity headline ambition level, that is the state of the ecosystems. The pollution ambition level focuses on addressing the pollution pressures. And the circular economy ambition level focuses on a system change to enable the achievement of other objectives. So it's to be seen as a response. Yeah, so much for the theory. Now we can have a look at the sectors covered. On the next slide, we have listed the sectors covered by the platform's recommendations, among them civil engineering, building, transport, restoration, and remediation. So Linda has already explained them all. And consistent with the first Climate Delegated Act, the platform on sustainable finance applied the NACE industrial classification system in defining technical screening criteria to the environmental objectives 3 to 6. And in some areas, NACE sectors were supplemented by additional categories when the current level of granularity within NACE was not sufficient. It is important to keep in mind that some sectors are more comprehensively included than others, and that some sectors are eligible for several of the objectives, while other sectors are eligible for only one of the objectives. So, for example, building is relevant for circular economy, restoration and remediation for all environmental objectives, but climate change mitigation. Yes, and with this, I hand it over to Anne. Anne, what activities are covered by the report of the platform?
Yeah, thank you, Nina. Yes, there are a lot of activities, but still, if there are a lot of activities and that the platform has done a tremendous work, we have to note that these activities covered are still restrictive. So what I mean is that there are still a lot of activities in the sectors covered which are not covered. So let's take some example. In the sectors listed, you see that in terms of number of activities covered, you have in agriculture 3, in manufacturing 15, chemicals, plastic packaging goods, etc. Energy, you have 1, etc. So our point was first of all to make you a synthesis of the activities covered, but also to show the paradox of one. There are still some sectors that are not covered, and even in the sectors, there are some activities covered, but a lot of activities which are not covered. In the first draft of the 4 environmental objectives, for example, there was the sector tourism that was drafted, which is not there anymore in the final report. And so, first of all, tourism is not there anymore. And for example, also in the tourism sector, it was only covered through the biodiversity objective, for example, where for tourism and hostel, we could expect also some other environmental objectives. So this was the paradox we wanted to show with the activities covered. But this is a long and time-consuming work, so it will be made progressively. And we expect some more criteria in May to cover 4 sectors and 7 activities which are listed on this slide. And it is also the occasion to repeat what Linda said before. It's not because you don't have your sector and activities covered for the moment that you cannot try to draft and discuss with the platform about potential criteria that could be pertinent for your activities. And also just to highlight that in the coming criteria that will come in May, there are some activities which are particularly challenging. So it will be a report that we will read carefully. And also we had planned to discuss about some example. We will just, because we could take hours to illustrate all the 4 other environmental objectives and explain the type of criteria that have been drafted for all these activities. So just that you keep in mind that for one activity, you can have many pages of technical criteria. So this is a first take. On this slide, we have just taken a small example about water supply on the objective protection of water and marine resources. So this is really just a small summary, but it takes many pages of a technical screening criteria. And included in the substantial contribution criteria, you will have what? For example, you will have reference to requirement of the Drinking Water Directive. You will have a reference to system that has received the necessary permits for water abstractions. You will also have reference to the leakage level, plus also the leakage index rating method. and other criteria like include metering of the water supply system will include metering at consumer level. This is just to give you an illustration of the technical screening criteria, but please keep in mind that they are quite complex. And Martin, the floor is yours for the extended taxonomy now.
Yes, thank you. So for the extended taxonomy framework, currently the green taxonomy is primarily binary. So in very, very simple terms, activities are either sustainable, green, or not. With the final report, the Platform on Sustainable Finance recommends how this green taxonomy could be extended. The extended taxonomy then could follow the color code of a traffic light. So you have your green activities that are the sustainable activities, just as we have them right now with the current taxonomy. But then there would also be red activities that actually significantly harm a climate objective, and yellow or amber activities that have an intermediate performance. These amber activities do not significantly harm an objective, but at the same time, they also do not substantially contribute to an objective yet. And one significant benefit of such an extension would be to support financing the transition away from significantly harmful activities. Because depending on the activity, this could either be done by transforming such activity or by immediately decommissioning or exiting such activities as fast as possible. So in both cases, investments are needed, and the extended taxonomy could facilitate this transition by adding information that is not part of the current taxonomy scheme. Moreover, the extended taxonomy defines activities with low environmental impact. Such activities do not have the potential to make a substantial contribution to any of the 6 environmental objectives, but they are also at the same time not at risk of causing significant harm to any of the 6 objectives, and they do meet minimum social safeguards. So such activities like professional services such as auditing or legal advice, as well as education, they should not be classified as green, amber, or red. They should thus be a separate category. And this separate category would benefit all companies that are not yet covered by the green taxonomy, so that they cannot be sustainable in a sense, but they would still have then their own category in the extension of the taxonomy. And also, such activities with a low environmental impact could still have access to green financing in the form of green investments, so in the form of green Capex and Opex. The focus on the sustainable transition is also shown on the next slide. The green arrows are already covered by the green taxonomy, so transitioning activities to achieve full alignment in the end. The yellow arrows, that are actually the ones that could be covered by the suggested extension of the taxonomy. These arrows show transition investments away from harmful activities, even if the criteria for the substantial contribution to be fully aligned in the end are not yet met. And then also, a final note, the red arrow, that's an example for a transition that is not sufficient, and that would not qualify as amber or green, even though a certain improvement is achieved, but the activity still significantly harms an objective even after the improvement. Please remember, in general, to the extension of the taxonomy, it is not yet clear whether the green taxonomy will actually be extended. This final report of the platform that has been sent to the legislators and that could be used to develop a respective legislation, but it's not yet clear if that will actually happen and when it will happen. This also brings us to another platform report regarding a social taxonomy. So, Anne, could you take over, please?
Thank you, Martin. Yes, so first of all, like for the extended taxonomy, on the social taxonomy, this is the same thing. We are on prospective topics, and for the moment, the Commission has not communicated a go or a no-go on this taxonomy, so the extended one or the social taxonomy. So for the moment, in practice, we cannot imagine that we will only stay with an environmental taxonomy and that there will be a social taxonomy coming. We can expect that, but we have to wait about an official launch, a go from the European Commission on this topic. So for the moment, we are with the report from the platform. And what is important on the social taxonomy is to say, yes, we have a report. So sometimes we have the impression that in the report that is not really precise, but we really wanted to highlight that in this report, there are already some very prescriptive items about what could be a social taxonomy. So in terms of overview, they have defined 3 objectives, so decent work, adequate living standards, and well-being for end users. And the third one, inclusive and sustainable communities and society. They have also defined sub-objectives, but I will come back to that later. Also, substantial contribution. They have defined what could be a substantial contribution in terms of social, because for the moment we are totally clear about what could be a substantial contribution in terms of climate, but it can be difficult to imagine the substantial contribution for social. So they have defined it like additional inherent social benefit of the activity itself, or avoiding and addressing negative impact on the workers and consumer and communities, and also enabling activities. We find again this notion of enabling activities that we already know. There will be also DNSH, and there will be also minimum safeguards, but which are still in discussion even in the report. I will go fast, but for decent work, I wanted to come back and say, you have this objective 1, decent work, and you can already discover the framework and the sub-objectives. So the 3 sub-objectives, this is promoting decent work, promoting equality and non-discrimination at work, and also ensure respect for human rights and workers in the value chain. And you have also this sub-objective that you can look at in the report. This is the same for the second objective, where you have sub-objectives as well, including, for example, protection of personal data and privacy, or responsible marketing practices. And for the third objective, inclusive and sustainable communities and societies, you have 3 sub-objectives: promoting equality and inclusive growth, supporting sustainable livelihoods and land rights, and ensure respect for human rights or of affective communities by carrying out risk-based due diligence. So this was just to go fast, but give you an overview of this framework. But what is really interesting now in this report is that they have tried to define the substantial contribution, as I said. And also they have given some example of high-risk sectors which could be targeted by this social taxonomy. Regarding, for example, living wages, there would be high-risk sectors with high prevalence of contingent workers, for example. So this is what we could expect. Or for training sectors with skills storage. And I wanted, before I end on the social taxonomy, also detail that there is a big section which gives examples of substantial contribution by activities. And for example, there is one, I think this is the first one, on training, which says, okay, you will have, like, for example, sectors with a shortage of skills, and a substantial contribution would be to reduce the negative impact on workers. And a substantial contribution could be that the entity runs extensive programs for skills and lifelong learnings, and also that there are high levels of workers' involvement in developing these programs. So you could have an Opex for training, for example. So this report is quite descriptive already. And Michael, the floor is yours for what's next.
Thank you, Anne. So if we move to the next slide, let's try to make a bit of a summary of what we can expect next. Today, during this presentation, we have talked about what we learned during 2021 and challenges in 2022. But then, if we take into consideration what has not yet been published, we have some things to expect. And you heard about that we are eagerly awaiting some FAQs on alignment from the Commission. And we don't know when they will be published, but hopefully very much before the end of the year, so we can have a chance to implement them and use them as a guidance for our reporting this year. Hopefully, we will have a delegated act on the other 4 environmental objectives that we have just covered. Unless we get that delegated act out in 2022, then the implementation of those 4 environmental objectives might be pushed forward 1 more year. So it's quite an interesting time now that we are waiting for that delegated act. As you heard, there's a lot of things coming from the platform, and a couple of things to look out for is, of course, then the report for the technical screening criteria and donor significant harm for the additional activities and criteria in relation to the 4 environmental objectives. So the package from the platform is not really complete yet, so we have to wait for that in May, and then we will have to wait for the delegated act from the Commission. Another thing that will come from the platform, as you've heard already, is that report on minimum social safeguards. I thought it would be worthwhile to point that out again. We did discuss during this presentation on how to apply the minimum social safeguards in advance of having that report coming out to us, but we need to make sure that we actually use that report whenever it comes to us, and hopefully it will come sooner than later. And as you just heard, we had Martin talk to us about the extended taxonomy and about the social taxonomy. We don't know yet whether these will be put into legislation or whether these will end up actually just becoming voluntary guidance for us to use if we want to report under some sort of extended idea of the taxonomy or for social factors. So with that, I'd like to thank our presenters for today, Anne, Martin, and Nina. And I would also like to thank our distinguished guests from the platform, Linda and Nadia, that contributed to making this presentation a success. So thanks to all of you, distinguished members of the Taxonomy Working Group, and thanks to you guys for listening in. And that is it for today. Bye-bye.